On the 7th of April at 5:32 p.m., Donald Trump announced a ceasefire with Iran. The next day, the market ripped higher. The S&P 500 closed up about 2.5%. The Nasdaq rose almost 3%. The Dow climbed more than 1,300 points, marking its best day in almost a year. A few weeks later, stocks were back near record highs, and if you only watched the traditional financial media, the story sounded simple. Peace arrived, uncertainty fell, markets celebrated. But that explanation is too simple. It is the kind of explanation that makes people feel better because it attaches a clean narrative to a complex machine. The problem is that markets do not move only because of headlines. They move because of positioning, leverage, liquidity, systematic trading rules, options hedging, forced buying, and human psychology reacting through mechanical systems. A headline can trigger the move, but the headline is not always the real cause. That is the first principle when the stock market rises after a ceasefire announcement. The easy story is that investors are celebrating peace. But if the ceasefire is already falling apart, if the Strait of Hormuz remains effectively impaired, if only a handful of carriers are moving through the route, and if the underlying supply shock has not been solved, then the rally cannot be understood as a simple vote of confidence in world peace. Something else happened. And what happened was a mechanical chain reaction, a short squeeze, a systematic CTA reversal, a negative gamma options flow, a market structure that no longer behaves like the old stock market people imagine. That is what I want to explain. Because if you do not understand the mechanics, you will misread the market. You will think rising prices mean the risk is gone. You will think headlines explain price. You will think the market is rationally discounting the future. And in modern markets, that is often not true. Sometimes the price is not telling you that the world is safer. Sometimes the price is telling you that too many people were positioned the same way and were forced to unwind at the same time. That is a very different message to understand the move after the 7th of April. We have to go back to the weeks before it. On the 28th of February, the United States and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed in the source narrative. Iran then shut down the Strait of Hormuz. The market entered its worst 5-week losing streak in nearly 4 years. By the end of March, the S&P 500 was down nearly 9%. That headline decline matters. But the deeper story is what was happening underneath the surface. Wall Street was not simply becoming cautious. Wall Street was crowding into a bearish position. Hedge funds were selling at the fastest pace in years. Goldman Sachs had a direct view into this because it runs a prime brokerage desk serving many of the major hedge funds. A prime brokerage desk sees what hedge funds are buying, what they are selling, how much leverage they are using, and how exposed they are. According to Goldman's numbers in the source document, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting above 300%, near an all-time high. Short exposure to macro ETFs like SPY and QQ reached the highest level since the pandemic. That is the key setup. The market was not just worried, it was positioned for more downside. When everyone is bearish and heavily short, the market becomes fragile in a different way. It can fall if the bad news continues, but it can also explode upward if a catalyst forces shorts to cover. That is the paradox. The more crowded a bearish trade becomes, the more explosive the upside can be if the trade begins to move against those who are short. This is why I always ask, what is the positioning? Not only what is the news. News tells you the story people are reacting to. Positioning tells you what must happen when the story changes even slightly. A heavily short market is like a forest full of dry wood. A single spark can create a violent fire. The ceasefire announcement became that spark. Now, before we discuss the squeeze, we must look at the fear that existed before the announcement. The market had reason to be afraid. The Strait of Hormuz is a critical global oil route. If it remains closed or impaired, the oil supply shock can be enormous. Analysts in the source document describe the potential disruption as bigger than anything in history. One estimate said the world might need to shed 15 million barrels per Dalton Y of demand in a severe scenario with the strait remaining closed. That kind of imbalance could push Brent crude to $250 or $300 per barrel. Not because anyone wants that, not because the world can easily handle that, but because price must rise enough to destroy demand when supply cannot get through. That is what commodities do in a supply shock. They do not respond to moral preference, they respond to physical scarcity. So the bearishness was not irrational. A closed Hormuz is a real macro risk. High oil can create inflation. Inflation can pressure bonds. Higher yields can pressure stocks. Energy shocks can damage consumers and corporate margins. A prolonged supply shock can create recessionary conditions. So the market was afraid for a reason. But here is the problem. A correct fear can still create a crowded trade, and a crowded trade can reverse violently even before the underlying risk has disappeared. This is one of the hardest lessons in markets. Being right about the macro risk does not mean you will be right about the next price move. The market can rally sharply while the long-term risk remains. That is what happened. On the 7th of April, the ceasefire headline arrived. The next morning, stocks opened higher and kept moving. More than 400 names in the S&P 500 finished green. 13 stocks made all-time highs. Brent crude dropped around 13.5%. WTI crude fell more than 16%. The biggest single-day decline since April 2020. That looks like a peace rally. But then look at the physical world. According to maritime intelligence firm Windward, which uses AI to cross-reference GPS signals with satellite radar and imagery, only 5 outbound carriers were detected moving through the strait by midday. 5 compared with a pre-war baseline of roughly 130 daily transits. That is about a 96% reduction in activity. So the physical choke point had not normalized. The oil route was not fixed. The war risk had not disappeared. The ceasefire was not the same as the restoration of global energy flow. Therefore, the rally cannot be explained simply as peace. If only 5 outbound carriers are moving through a route that normally handles enormous global energy flow, the supply chain is still impaired. The market was not calmly pricing a solved problem. It was violently unwinding a crowded position. That is the difference. Now let us explain the short squeeze. When you short a stock, you borrow shares from someone and sell them. You are betting that the price will fall. If the price falls, you can buy the shares back cheaper, return them to the lender, and keep the difference. But if the price rises, the trade moves against you. You still owe the shares to close the position. You must buy them back. If the price rises enough, your broker may demand more collateral. That is a margin call. If you cannot or do not want to post more collateral, you must close the position. Closing a short means buying. So when prices rise and short sellers are forced to cover, their buying pushes prices even higher. That higher price forces more short sellers to cover. That creates more buying. This is the squeeze. The buying is not necessarily bullish conviction. It is forced buying. That distinction matters. A short squeeze can make prices rise very fast, even if the underlying fundamental story is still uncertain. The price moves because the structure demands buying. On the 8th of April, macro short exposure was at the highest level since 2020. That means the market was full of traders who had effectively bet against broad equities. When the ceasefire headline pushed prices up, those short positions moved against them. Some covered immediately, others were forced to cover as prices rose. The buying pressure began feeding on itself. This was the first domino, but it was not the only one. The second domino was the systematic trading community, CTAs, commodity trading advisors. Despite the name, many CTAs trade across multiple asset classes, including equities, bonds, currencies, and commodities. They often use rules-based models. They are trend followers. They do not sit around debating whether the ceasefire is real. They do not call diplomats. They do not study the personality of political leaders. They do not ask whether Hormuz is truly open. They look at price, trend, volatility, and trigger levels. When the trend is down, the model can short. When the trend flips up, the model covers shorts and can go long. That is mechanical, and mechanical flows can become enormous when enough capital is following similar signals. Goldman reported that CTAs were sitting on about a $30 billion net short position going into the ceasefire. When the SP crossed certain trigger levels, these models began to flip, not from bearish to thoughtful, from short to long. Originally, Goldman estimated that CTAs would need to buy about $40 billion of equities to exit shorts. The actual figure ended up being about $86 billion across 5 trading sessions. According to Goldman's records, that was a top 5 buying speed print of all time. That is not a normal human reassessment of peace. That is mechanical demand. A price move triggers a model. The model buys. The buying pushes the price higher. The higher price triggers more models. The system compounds the move. This is the second domino. The third domino was the options market. Options dealers are often on the other side of customer option trades. If customers buy call options, dealers may need to hedge by buying the underlying stock or index exposure. They do this to stay delta neutral in normal conditions. Dealer hedging can sometimes stabilize markets, but in a negative gamma regime, dealer hedging becomes pro-cyclical. That means when prices rise, dealers must buy more. When prices fall, they must sell more. Instead of dampening movement, hedging amplifies movement. Spot Gamma had flagged a negative gamma regime heading into the ceasefire that matters, because once prices began rising, dealer hedging added more buying pressure. Customers bought calls or existing option exposures moved in ways that required hedging dealers bought underlying equities. That buying pushed prices higher. Higher prices required more hedging. The loop intensified. So the rally was not one thing, it was three things stacked on top of one another. Short sellers forced to buy, CTAs flipping from short to long options, dealers hedging in a negative gamma regime. That is the actual machine. The ceasefire announcement was the match. The dry wood was positioning. The wind was systematic flows. The accelerant was options hedging. That is why the rally was so violent. Now, if you understand this, you stop asking childish questions like, why did stocks rise if war is bad? The answer is that stocks did not rise because war is good. They rose because the structure of the market created forced buying after a bearish crowd became too crowded. A market can rise on bad fundamentals if the positioning is wrong. A market can fall on good news if everyone was already positioned for it. Price is not the same as truth. Price is the result of flows. That is the principle. Now, this kind of event is not new. The source document compares it to December 2018. Stocks had been crashing for months on fears of rate hikes. Then Jerome Powell used the word patient. One word, the Dow exploded. It was the first time the Dow had ever gained more than 1,000 points in a single session. Was the entire economy transformed by one word? The word changed positioning, expectations, and flows. The market structure did the rest. Another example is August 2024, when the Bank of Japan raised rates for the first time in 17 years. The yen carry trade began to unwind. The Nikkei dropped 12% in one day and then bounced 10% the next. Again, the catalyst was different. The mechanism was similar: crowded positioning, leverage, forced selling, or forced buying. Rapid reversal. Mechanical flows markets today are full of these feedback loops. The headlines change, the machine remains. That is why the same pattern keeps repeating. Now we need to understand why the modern market behaves this way. 20 years ago, the market was more dominated by human portfolio managers, analysts, and discretionary investors. They read earnings reports, they modeled cash flows, they debated valuation, they tried to decide what companies were worth. That world still exists, but it no longer dominates in the same way. Today, a large portion of the market is driven by passive funds, systematic strategies, leveraged hedge funds, options flows, and index allocation rules. According to the source document, 63% of U.S. stock funds are now held by passive indexers. That represents more than $13 trillion of blind money. Blind does not mean stupid, it means rules-based. A passive index fund does not care whether Apple had a good quarter. It does not decide whether Nvidia is too expensive. It does not debate whether the economy is slowing. It follows the index. If money flows into the fund buys the index. If the index is market cap weighted, the biggest companies get the most money. The bigger a company becomes, the more passive money is forced to allocate to it. That is how the Magnificent Seven grew to more than 33% of the S&P 500 in the source narrative. This creates a reflexive structure. Size attracts flows. Flows increase size. In a market cap weighted system, winners keep receiving more allocation simply because they are bigger. This does not mean the companies are bad. Many are extraordinary businesses, but it means part of the buying is not valuation sensitive, it is mechanical. That changes the nature of price discovery. A large part of the market is no longer asking what a company is worth. It is receiving allocation by formula. That is a major structural shift. Now, the active side of the market has also changed. The hedge fund industry has consolidated into giant multi-strategy platforms. Funds like Millennium, Citadel, and Point72 dominate large parts of the institutional ecosystem. These funds often run multiple independent teams under one platform. They can use significant leverage. The source document describes leverage in the range of 4 to 8 times. They also operate with strict drawdown rules. When a team loses too much, risk is cut quickly, positions are reduced, trades are closed. The system does not wait for philosophical debate, it acts. This means when many funds hold similar exposures and the market moves against them, forced deleveraging can happen quickly. A portfolio manager may have a nuanced long-term view, but the risk system does not care about nuance. If the drawdown limit is hit, the position is reduced. That creates more selling or buying pressure. This is another reason modern markets move violently. Risk controls create feedback loops. The purpose of the controls is to protect the fund, but when many funds share similar controls, the collective effect can destabilize the market. Now, underneath all of this is the options market. The source document highlights same-day expiration options, 0 days to expiration contracts. These have become a huge part of SP trading. Around 63% of all SP options trading in the source narrative involves same-day expiration options on peak days. Over $2 trillion of notional value can change hands in a single session. That is enormous. These options force dealers to hedge in real time. If customers buy calls, dealers may buy the underlying exposure. If customers buy puts, dealers may sell. If the market moves, hedges must be adjusted. When the flows are large enough, they do not just respond to price, they influence price. This is why the options market can turn a move into a cascade. Price moves, dealer hedging responds. The response moves price further, more hedging follows. This is not fundamental investing, this is market microstructure, and it now matters enormously. So when people say the market rallied because of peace, they are missing the system. The market rallied because passive funds, Connecticut, as short sellers, hedge fund risk controls, and options dealers created a feedback loop. Peace was the story, mechanics were the engine. Now this raises a deeper issue. The stock market, many people think they understand, may no longer exist in the same form. People still imagine a market where investors study companies, estimate intrinsic value, and allocate capital based on fundamentals. That still happens. But it competes with a much larger machine, a machine of index flows, a machine of leverage, a machine of systematic rules, a machine of dealer hedging, a machine of risk limits, a machine of options speculation. The market is not only a weighing machine or a voting machine, it is also a positioning machine. And in the short term, the positioning machine can dominate everything else. That does not mean fundamentals do not matter. Over long periods, earnings, cash flow, balance sheets, competitive advantage, and productivity still matter. But over days, weeks, or even months, flows can overpower fundamentals. This is why long-term investors must be careful about interpreting short-term price. A rally does not always mean fundamentals improved. A crash does not always mean fundamentals deteriorated. Sometimes price moves because the machine needed to rebalance, cover, hedge, or deleverage. This is especially true around major macro headlines. War, ceasefires, rate decisions, central bank language, inflation prints, employment reports. The headline is often the trigger. The positioning is often the fuel. Now let us go back to the 8th of April rally. Traditional media called it relief. But relief from what? If Hormuz traffic was still down 96%, if only 5 outbound carriers were detected, if the ceasefire was already unstable, then the physical risk remained. The market's behavior was not the same as the real-world situation. This is common. Markets can respond to the probability of a better future before the better future exists. But in this case, the strength of the rally was too large to explain only by improved probability. The scale of forced flows mattered more. When short sellers buy to cover, they are not necessarily changing their view. They are reducing losses. When CTAs buy after triggers are crossed, they are not deciding peace is durable. They are following rules. When dealers buy stock to hedge options, they are not expressing optimism, they are managing exposure. The buying may look the same on the tape, but the reason behind the buying is different. That is critical. The market does not label each buy order as conviction, forced covering, systematic trend following, or dealer hedge. It all appears as demand. But a serious investor asks what kind of demand it is. Conviction demand can persist if fundamentals improve. Forced demand may fade once positioning normalizes. Systematic demand can reverse when trend signals reverse. Dealer demand can disappear or invert as options positions change. That means a rally built on mechanical flows may be less durable than a rally built on improving fundamentals. Not always. Sometimes a mechanical rally becomes self-reinforcing and fundamentals catch up later. But the origin matters. You should not blindly trust a mechanical rally as confirmation that the risk is gone. Now, the source document argues that the financial media simplifies these moves because the real mechanics are difficult to explain. It is easier to say markets rallied on peace hopes. That sentence is simple. It fits a headline, it gives viewers closure, but it is often incomplete. A sophisticated investor needs to resist narrative closure. The mind likes clean stories. Markets often run on messy plumbing. This is why I spend so much time thinking about flows and structure, not because I ignore fundamentals, but because fundamentals do not explain every move. If you cannot understand why a market rallies when the world is still dangerous, you may panic or chase at the wrong time. You may think the market is irrational. In one sense it is, but in another sense it is perfectly mechanical. It did what its structure forced it to do. That is why I prefer the word mechanical over irrational. The market may not be wise, but it often follows clear incentives and constraints. Now, what are the implications for investors? First, do not mistake price for certainty. Stocks at record highs do not mean the war risk disappeared. They may mean bearish positioning was squeezed out. Second, do not short crowded markets without understanding squeeze risk. A short thesis can be fundamentally sound and still be destroyed by positioning. When leverage is high and short exposure is crowded, a single headline can trigger forced buying. Third, understand that systematic flows can create moves larger than the news deserves. CTAs, risk parity funds, vol control funds, and other rule-based strategies can move capital fast. Fourth, option structure matters. Negative gamma regimes can amplify moves. If you do not watch options positioning, you may not understand why the market is moving so violently. Fifth, passive concentration matters. When a large part of the market is allocated by index rules, the largest names can receive flows, regardless of valuation. That can extend trends beyond what fundamental investors expect. Sixth, risk management matters more than prediction. If you assume the market will behave rationally according to the news, you may be surprised repeatedly. Now let us think like Ray Dalio. The market is a machine. A machine has parts. The parts have incentives. Hedge funds are leveraged and must manage drawdowns. CTAs follow trend signals. Dealers hedge option exposure. Passive funds allocate based on index weight. Retail traders chase price and headlines. Financial media creates narratives after the fact. Central banks influence liquidity and discount rates. Geopolitical headlines change expectations. All these parts interact. If you only watch one part, you misunderstand the machine. The 8th of April rally was not one cause. It was a chain reaction ceasefire headline. Short covering, CTA reversal. Dealer hedging, passive and momentum buying. Narrative confirmation, more buying, higher prices, more forced covering, that is the chain. Once you see it, the rally makes sense, not because peace was real, because the machine was positioned to explode upward if even the appearance of peace appeared. Now, what happens after such a squeeze? There are several possibilities. The rally can continue if systematic buying persists, passive flows remain strong, and investors who missed the move chase it. The rally can stall once shorts are covered and the forced buying is complete. The rally can reverse if the original risk returns and positioning becomes long instead of short. The rally can become a new uptrend if fundamentals improve or liquidity expands. The outcome depends on what happens after the mechanical buying exhausts. That is why the next phase matters. If the ceasefire fails, if Hormuz remains impaired, if oil pressure returns, if inflation risk rises, then the market may have simply created a better level from which to fall. If the ceasefire stabilizes, if shipping normalizes, and if inflation pressure drops, then the rally may be justified later, even if the first move was mechanical. The investor must separate the reason for the initial move from the eventual fundamental outcome. A mechanical move can become fundamentally confirmed, or it can fail. You must keep watching the real system, do not stop at the price. Now, let us talk about short squeezes more broadly. Short squeezes are powerful because short selling has asymmetric risk. If you buy a stock, the most you can lose is the amount you invested, assuming no leverage. If you short a stock, losses can theoretically be unlimited because the price can rise far beyond where you sold it. That creates pressure. When a short moves against you, the pain rises as price rises. At some point, you must buy back. That buyback is demand. If many shorts must buy at once, demand becomes intense. This is why crowded shorts can create vertical rallies. The buying is not optional, it is risk control. Now, in macro ETFs like SPY and QQQ, this becomes even more powerful because the instruments are broad and liquid. Hedge funds can use them to hedge or express macro views. If many funds short the same macro ETFs and the index moves against them, the covering can lift the whole market, then the index rise affects passive funds, options, systematic strategies, and sentiment. That is how a broad market short squeeze can become a full market rally. This is not the same as one small stock squeezing. It is the index itself becoming the squeeze vehicle. That is what made the April move so powerful. Now, Connecticut AS can add a second wave because they are price reactive. If the market has been falling, Connecticut AS may be short if price crosses certain moving average momentum or volatility adjusted triggers, they cover and go long. This buying is not one trade. It can happen across many systems around similar levels. The more price rises, the more signals can flip. This is why buying can accelerate over several days. Goldman estimated $40 billion. The actual 5-day buying was $86 billion. That is not a small adjustment. That is a large mechanical flow hitting the market quickly. Now, options dealers add a third wave when gamma is negative. Let us explain this simply. Gamma measures how an option S delta changes as the underlying price changes. Dealers often hedge delta in a negative gamma environment. If the market rises, dealers need to buy more to stay hedged. If the market falls, they need to sell more. That means their hedging amplifies the move. It creates a buy, high, sell, low dynamic from the dealer side. When customer options activity is large enough, this can have major market impact. Same day options make this more extreme because hedging must happen quickly, and the notional amounts are huge. This is why modern markets can move violently in a single session. It is not only human emotion, it is derivative structure. Now, passive funds create a slower but powerful background force. When money enters index funds, the funds buy the index. The largest companies get the biggest allocations. If mega-cap stocks are already leading, passive flows reinforce their leadership. This can make the index look stronger than the median stock. It can also concentrate risk. If the Magnificent Seven represents more than a third of the S&P 500, then index performance becomes heavily dependent on a small group of giants. This does not mean those companies are bad. It means the index is less diversified than many people assume. Market cap weighting can create hidden concentration. When momentum is strong, that concentration helps. When leadership breaks, it can hurt. So passive investing is a wonderful tool, but it changes market structure when it becomes dominant. It does not analyze price. It allocates according to rules. Rules can create flows. Flows can change prices. Prices can change weights. Weights can attract more flows. That is reflexivity. Now, multi-strategy hedge funds create another kind of reflexivity because they operate with tight risk limits. Losses can create forced position reductions if many funds are in similar trades. One fund de-risking can move prices, causing another fund to hit limits, causing more de-risking. That can create cascades. On the downside, it can create sharp sell-offs. On the upside, if funds are short, it can create sharp rallies. Again, the mechanism is symmetric. Forced selling and forced buying are both possible. The direction depends on positioning before the 8th of April. Positioning was heavily bearish, so the forced move was upward. Now, what is the practical investor lesson? Do not assume that because a rally is mechanical, it must immediately reverse. Mechanical flows can be powerful enough to create lasting trends, but also do not assume that because the market rallied, the risk was resolved. The correct response is to ask what has changed in the real economy. Did shipping through Hormuz normalize? Did oil supply recover? Did the war de-escalate materially? Did inflation risk fall? Did earnings expectations improve? Did liquidity conditions change? Or did positioning simply unwind? If the answer is mostly positioning, then you treat the rally differently, you respect the price move, but you do not let it change your entire worldview. Markets can stay irrational longer than you can stay solvent, but they can also mislead you with price strength. The disciplined investor does not fight the tape blindly, but he also does not worship it. He studies the machine. Now, why can markets be at all-time highs during war? Because markets are not moral instruments. They do not go down because events are bad in a human sense. They go up or down based on expected cash flows, discount rates, liquidity, positioning, and flows. War can be bad for human beings and good for some sectors. War can raise deficits and hurt bonds. War can create energy shocks and hurt consumers. War can cause governments to spend more and support defense companies. War can create fear, then relief, then forced buying. The market response depends on the mechanism. A war headline is not enough. You must ask how the war changes money flows. In this case, the ceasefire headline changed positioning flows faster than it changed the real-world supply problem. That is why stocks rose. Now, what about oil? Oil fell sharply after the ceasefire announcement. Brent fell around 13.5%. WTI fell more than 16%. This was one of the largest daily drops since April 2020. But again, if only 5 outbound carriers were detected moving through the strait by midday, then the oil price move may have also been a positioning unwind. Oil traders were positioned for severe disruption. The ceasefire headline forced repricing. Long oil positions may have been sold. Short oil positions may have gained. But the physical issue remained. This is the same lesson in reverse. Oil falling does not necessarily mean the supply problem is solved. It may mean the fear premium was squeezed out temporarily. Again, price is not truth. Price is flow and expectation. The physical world must confirm. If shipping normalizes, oil can continue falling. If shipping remains impaired, oil can rise again. The investor must watch reality, not only futures prices. Now, let us think about the psychological trap after a big rally. People who sold or shorted feel pain. People who stayed long feel relief. People who missed the move feel pressure to chase. Financial media becomes optimistic because price went up. The narrative shifts quickly. Fear becomes relief. Relief becomes confidence. Confidence becomes complacency. But if the underlying risk remains, complacency can be dangerous. This is why mechanical rallies can create the worst kind of setup. They make people believe the problem is solved just as positioning shifts from defensive to more exposed. Then if the real problem returns, the market can fall again. This does not always happen, but the risk is there. The key is to avoid emotional conclusions. A rally is data. It is not proof. Now, what should a long-term investor do with this information? First, maintain humility. Modern markets can move in ways that appear disconnected from fundamentals for longer than expected. Second, avoid excessive leverage. If the market can move violently because of mechanical flows, leverage can destroy you even when your thesis is right. Third, understand that hedging is difficult. A hedge can fail temporarily if a squeeze moves against it. Fourth, keep liquidity. Cash gives you the ability to respond without being forced. Fifth, do not assume that the index is diversified in the way it once was. Mega-cap concentration and passive flows matter. Sixth, do not let financial media explanations replace your own analysis. The narrative after the move is often written to fit the price. Seventh, focus on your time horizon. If you are a long-term investor, short-term mechanics matter, mainly because they can create entry points, exit traps, and emotional stress. They should not make you abandon a sound plan every time the market moves. Now let us think about the deeper structural change. The old market rewarded patient analysis of individual businesses. That still matters, but the market surface is now dominated by flows. This creates a strange environment. A company can beat earnings and fall because positioning was too long. A company can miss earnings and rise because shorts are forced to cover. An index can rally on a headline that does not solve the real problem. A sector can move because options dealers are hedging customer flows. A mega cap can receive buying because passive index inflows require it. If you are expecting every price move to reflect intrinsic value, you will be confused. The modern investor needs two layers. The long-term layer, business fundamentals, valuation, productivity, earnings, cash flow, competitive advantage. The short-term layer, positioning, leverage, systematic flows, options gamma, passive concentration, liquidity, sentiment. The long-term layer tells you what you want to own. The short-term layer tells you why prices may move violently around that value. You need both. If you only study fundamentals, you may not understand the timing and volatility. If you only study flows, you may trade without knowing what assets are worth. Both extremes are dangerous. Now, let us revisit the statement that the old stock market is gone. I would say it more precisely. The old stock market is not gone, but it is no longer the only dominant layer. Fundamental investing still exists. But the market's short-term behavior is increasingly shaped by non-fundamental flows. This means price discovery has changed. Indexing, leverage, systematic models, and options hedging all affect price formation that can create distortions. But it can also create opportunities for patient investors. If forced flows push good assets too low, long-term investors can buy. If mechanical flows push prices too high, disciplined investors can reduce risk. But to benefit, you must recognize the difference between forced movement and fundamental change, that is the skill. Now let us look forward. If the ceasefire fails, the rally may be tested. If Hormuz remains nearly closed, oil risk may return. If oil risk returns, inflation expectations may rise. If inflation expectations rise, treasury yields may rise. If yields rise, equity valuations may compress. If hedge funds and CTAs have shifted from short to long, the next reversal could produce forced selling instead of forced buying. That is the risk. A market that was short and squeezed upward can become long and vulnerable later. The mechanical machine does not care about direction. It amplifies whichever way the triggers point. This is why understanding mechanics is not just for explaining the past. It helps assess the future. What is the current positioning after the squeeze? Are CTAs now long? Are dealers still in negative gamma? Are options flows concentrated in calls? Are passive inflows continuing? Is leverage rising again? If the answer is yes, then downside risk may rebuild. Markets can shift from under-owned to crowded quickly. That is the dynamic. Now, if the ceasefire stabilizes and Hormuz reopens, the rally may continue. Oil could fall, inflation pressure could ease. The Fed could have more room, risk assets could benefit. Short squeeze buying could become real momentum. Momentum could attract more flows. The market could remain at highs. That is possible. The point is not to predict one path with certainty. The point is to know what path you are exposed to. If the rally is based on a true improvement in the physical system, it is stronger. If it is based only on forced flows, it is weaker. The physical confirmation matters. Watch Hormuz traffic, watch oil, watch inflation expectations, watch treasury yields, watch positioning, watch options gamma, watch credit spreads. The market will tell part of the story, the real world will tell the rest. Now, let us close the lesson. The 8th of April rally was not simply the market celebrating peace. It was a mechanical unwind of extreme bearish positioning. The stock market was heavily short through hedge funds and macro ETFs. Gross leverage was high. CTA models were short and then flipped. Options dealers were operating in a negative gamma regime. Passive index flows and mega cap concentration made the move stronger. Same-day options increased the speed of hedging. The headline created the trigger. The structure created the explosion. This is why markets can be at record highs while war risk remains. It is not because the market has become wise. It is because the modern market is a feedback loop. Algorithms, passive funds, leveraged hedge funds, and options dealers react to price and to each other. Then the media builds a story after the fact. The story may say relief rally. The machine says squeeze. If you understand the machine, you will not be fooled by the story. You will still respect the price. You will not fight it blindly, but you will know that the rally itself does not prove the world is safe. It only proves that the market was positioned in a way that made a rally possible. That distinction can protect you. Because in markets, the danger is not only being wrong about the world, the danger is being right about the world, but wrong about the positioning. And when leverage, algorithms, passive flows, and options hedging all move at once, positioning can dominate the world for a while. That is the market we are living in. A giant feedback loop, a machine that can turn one headline into $86 billion of buying, a machine that can make war look bullish for a few weeks, a machine that can make investors believe a problem has disappeared. Because price went up, do not confuse the machine with reality. Study both. That is how you survive this market.